Welcome to the Deep Dive. Today, we're dissecting a truly counterintuitive market event. It involves SoFi Technologies, a company that just delivered, knockout earnings, saw its stock surge, and then, bafflingly, took an immediate dip in after-hours trading. The question, of course, is why. And this is where it gets really interesting.
It really does. It highlights this, fascinating tension you see with high-growth companies.
Yeah.
When do you leverage really stellar performance for these big strategic capital plays? And what are the immediate trade-offs? So for this deep dive, we've gone through detailed reports on SoFi's Q2 earnings, their recent stock offering, and of course the market reactions that followed. Our mission really is to help you understand the kind of interplay of strong financial performance, these strategic capital moves, and, well, investor sentiment that played out.
Okay, so let's start with piece number one. SoFi's second quarter results, they were frankly incredible. And initially, they sent the stock soaring. We're talking revenue surging, around 43 to 44% year over year. It hit between $854.9 million and $858 million. And the adjusted earnings per share, EPS, that came in at 0.08 cents. Both those numbers significantly beat what analysts were forecasting. They were expecting something closer to $809 million for revenue and maybe $0.06 for EPS. Big beat.
Huge beat. And beyond those, impressive top and bottom lines, the growth metrics across SoFi's actual business lines, they also told a really powerful story of expansion.
Right, tell us about that.
Yeah, so they added 850,000 new members. That brings their total up to a record 11.7 million. That's a 34% year-over-year increase. It really highlights their customer acquisition engine. It's humming. In management, they're projecting adding at least 3 million new members this year. That's roughly a 30% rise. And what's maybe even more impressive is the loan originations. You saw significant year-over-year growth in, all categories. Personal loans were up a massive 66% to $7 billion. Student loans jumped 35% to $1 billion. And home loans, they surged 92% to nearly $800 million.
That's across-the-board strength.
Exactly. These numbers, they really underscore SoFi's robust position in, digital banking and its core lending business. Record originations, record revenue performance like this. It doesn't just happen. It highlights a very strong underlying business. They're executing well.
And like you'd expect, the market reacted positively right away. Following those earnings, SoFi shares surged, 15 to 18% during the day? It was the company's best ever quarterly profit.
Best ever. And what's more, the company also raised its full-year guidance. Adjusted net revenue guidance increased to approximately $3.375 billion. That's up from a prior range of $3.235 billion to $3.31 billion. And GAAP EPS guidance, that got updated to around 31 cents, from over $1.27 to $1.28 previously.
So higher targets for the year.
Right. Though it's worth noting, some analysts think this raised guidance might actually still be a bit conservative. Given how strong the first half was, they might be underplaying their momentum a little. Let's see.
Okay, so after all that fantastic news, huge earnings beat, raised guidance, stocks soaring, you might think SoFi was set for just, smooth sailing upwards, right?
You would think.
Not so fast. Almost immediately after that stellar earnings report, something else dropped. News of a public stock offering. Okay, let's unpack this. So SoFi filed what's called a shelf registration and launched an underwritten public offering of $1.5 billion in common stock.
Right. Big number.
Yeah, and just to quickly demystify that for you listening, a shelf registration basically means they get pre-approval from the SEC to issue shares over time. It's like putting shares on a shelf to sell later when conditions are right. An underwritten offering means a bank, in this case, Goldman Sachs, guarantees the sale. They buy the shares and resell them. It adds confidence and efficiency. This deal even included a 30-day option for Goldman to purchase an extra 15%. So the total potential raise could be up to $1.725 billion. The stated reason, general corporate purposes. That includes working capital, strategic opportunities. Pretty vague, though. No specific uses were actually disclosed.
Right. That general corporate purposes line is pretty standard. But strategically, you have to ask, why now? Why such a large capital raise right after amazing results? It strongly suggests they're shoring up their capital base, strengthening it. To support further growth, definitely. It gives them operational flexibility and maybe positions them for potential M&A, mergers and acquisitions, or maybe bigger R&D investments.
So it's about fueling future growth, possibly bigger moves.
I think so. It connects directly to their stated goal. Keep building out their financial platform, expand their offerings. What's fascinating here is how a company with such strong earnings, seemingly flush, still chooses to raise a lot of capital. It signals ambition.
Okay, ambition. But then came the market reaction, which was immediate And let's be honest, a bit perplexing for some. Following the news of this offering, SoFi shares fell, 5.9 to 6% in after-hours trading. They settled near $21.05. And this was despite that huge intraday surge earlier. I bet a lot of listeners checked their portfolios right after earnings, felt great, then did a double take at the after-hours dip. Certainly keeps you on your toes.
It does. And the primary reason, the main driver for that dip is something called share dilution.
Okay, break that down for us.
Sure. Think of it like this. Imagine you own, say, 10 slices of a pizza cut into 100 slices. You own 10% of the pizza, right? Now, if the company suddenly decides to cut the same pizza into 200 slices by issuing new shares, your 10 slices are still 10 slices, but now they only represent 5% of the whole pizza.
Ah, okay. Your slice of the pie got smaller, proportionally.
Exactly. Your share of the whole company has been diluted. When a company issues new shares like this, there are more shares out there in the market. So each existing shareholder's proportionate ownership goes down, and crucially, their potential claim on future earnings per share also gets smaller. So even with strong earnings, these big capital raises often, cool investor optimism, at least in the short term. It raises that important question: is this good or bad long term?
Right. So it's about strengthening the company's financial base for the future. But, some might argue that a capital raise this big, especially right after such strong earnings, could signal something else. Could it signal a need for capital they're not openly stating? Or maybe some underlying weakness the market's picking up on? How do you address that kind of counter-narrative?
That's a totally valid point, and it's a natural concern for investors whenever there's a big offering. You always wonder, why now? Sure. However, in SoFi's specific case, you look at their record Q2 performance, you look at the fact they have a full bank charter now, it really suggests they're seizing an opportunity from a position of strength, not desperation. This capital, it might be earmarked for strategic acquisitions, perhaps picking up smaller fintechs in a landscape that's likely to consolidate. Or maybe it's just about building a larger war chest to navigate potential future economic bumps, making sure they can keep lending and growing no matter what the market throws at them. It feels more like long-term resilience and opportunistic growth planning.
Okay, that makes sense. Positioning for the future from strength. And it's really crucial to balance the picture here for everyone listening. Despite that after-hours drop, SoFi stock was still up significantly for the year, something like 45% year to date. And it retained a really strong relative strength rating, a 97. For context, a rating of 97 out of 100 means it's outperforming 97% of all other stocks. This is a very strong technical signal. The stock actually still ended up among the top movers in the market that day, even with broader market pullbacks happening because of news around the Federal Reserve meeting. So putting all this together, what does this really mean for you, the listener, trying to make sense of it?
Yeah, it depends on your perspective, right? For long-term investors, this capital raise, seen through the lens of those record Q2 results, can actually be a positive signal. It signals SoFi's aggressive growth strategy, their strong financial footing now. It reinforces a positive outlook if you believe in their core lending and member growth story. It suggests they're gearing up for significant future expansion.
Okay, so potentially good for the long haul. Potentially, yes. However, for shorter-term traders, or those more sensitive to immediate price action, the dilution risk is real. And the volatility that comes with it might warrant some caution. The stock issuance definitely introduces near-term downside risk and choppiness, even though the underlying fundamentals look strong. It's sort of a classic case. Great news on performance, followed by a necessary but temporarily unsettling financial maneuver.
And let's not forget that analyst perspective we touched on earlier. The idea that SoFi's updated full-year guidance, even though it was raised, might still be overly cautious, that it perhaps implies a slowdown in the second half of the year that doesn't quite mesh with their historical growth rates. Now, that could be setting a low bar, potentially setting the stage for future beats and upward revisions if they keep outperforming, or it could be genuine caution. Exactly. So, if we try to summarize the overall takeaway here, SoFi delivered a really compelling financial beat, accelerating growth across all their business lines, strong membership expansion, plus they upgraded their guidance. That shows powerful underlying fundamentals. However, stock issuance that came right after, while it strategically addresses their future capital needs and positions them for aggressive expansion, it absolutely introduced dilution risk. And that led directly to that near-term volatility, despite the company's strong performance report just hours before.
It really is a lot to consider, isn't it? A mix of great performance and strategic financial engineering with immediate consequences for the stock price. So the final thought maybe to leave you with is this. Given SoFi's impressive organic growth and now this significantly strengthened capital base from the offering, how might this big cash infusion actually propel their expansion? Could it lead to new strategic opportunities? And what kind of ripple effects could that have on the competitive landscape in this really dynamic fintech sector? What stands out to you about this whole sequence of events? Something to mull over.